Hey everyone. Now, on behalf of myself, Brad, and the Phantom team, we hope thus far you've had an absolutely incredible week. Be that taking time off and treating this week as a holiday to spend with your family, friends, and loved ones, which I essentially have, or taking complete full advantage and exploiting the markets, as we have seen some absolutely textbook trade setups throughout this week, which many of the community have absolutely been smashing. Alternatively, some of you, which is also very pivotal in your trading career in order to take your trading to the next level, taking your time and taking a step back and focusing on the fundamental processes and building the infrastructure that you require to, in your own self-ideology, becoming a consistently profitable trader. So backtesting, ASR, educational resources throughout the Phantom community, or individual coaching sessions that some of you have, of course, been having. Now, because Brad and I decided that it wouldn't be right to release a midweek market commentary, as we wanted to make sure that we didn't set the wrong rhetorical tone surrounding the macros that are currently present in the market, with the volatility, increase in margins across most retail brokers, the spread increases, which thus in turn can cause greater slippage in the most liquid of asset classes and cross-currency pairs in terms of majors, cable, euro dollar, sterling yen, dollar yen. These liquid pairs can experience extreme slippage during highly volatile times where volume is just a tenth of what it is under traditional trading conditions. Now, it isn't wrong if you've actually traded this week, nor is it if you haven't traded this week. Some of us understand that this time can make you and it can break you. And depending on where you are in your trading journey and how much return on investment you've secured for the year or the week or the month, there's a few different viewpoints on how to actually target this and how to actually action this. Some of us allocate a particular percentage to this style of trading around this week, where we'll risk X amount of percentage so that we can be involved in the markets to take advantage and exploit any opportunity that presents itself. Alternatively, we can take a step back and be completely relaxed, which I've favoured more this week, just because of where we are in our performance and what we've been able to achieve over the last year or two. So for me, I've taken a step back and I've really enjoyed this week. I spent Wednesday on the water, kayaking, and then the rest of the week it's just pretty much about really digging into the back-end administration for Phantom with Brad to understand how we can provide more value. So, because we didn't do a midweek market commentary, Brad and I thought it'd be quite good and of great value to the community to just touch upon how we trade the Asian session and looking at a few case studies from trades that we've taken over October in cable specifically, so that you guys can understand how we use this additional confluence as an advanced entry technique to set the tone and rhetoric for the London and New York sessions, to increase our strike rate, and ultimately understand what the markets are doing from an institutional standpoint. So without further ado, let's dive into the charts and let's look at how we exploit the Asian session and how we take the trades on London Open. Starting on the daily time frame within cable, we can clearly see that we're in a downtrend. The bears have been pretty much in full control since the GFC in 2007-2008, and the market has continuously made lower highs and lower lows. Now, zooming into most recent price action, we can of course see from 2017 and 2020 that yes, we are in a downtrend and the bears are in control. However, the mid-trends and substructures inside the daily timeframes quite clearly show that bullish momentum has of course kicked in, and we have seen markets create subsequent breaks of structure and higher highs and higher lows have been printed, which as traders we can take full advantage of and exploit subject to the edge and methodology surrounding the Phantom strategy being intact. Now, nothing is ever going to be utopian, nothing is ever going to be textbook and vanilla. The markets don't paint perfection. If we were to actually zoom in just a little bit more, since the beginning of 2020 when this V bottom was created, if we zoom out, we can see that we was reacting to the lows that were set in 2016 around the 116 handle, and we saw a really nice sweep of those lows, sapping into that liquidity, and of course just taking out pretty much all of the sell orders and stops for longs and shorts, trapping the bears, suffocating them, and pretty much stopping at any bulls that were still in trades moving to the upside, which cleared the way for further upside momentum. We're making higher highs, clear significant breaks of structures all the way to the upside, then started to move correctively for the last 3 or 4 months since August, which isn't an issue. As traders, we're going to take full advantage of that. So in terms of our bias, just based on the daily time frame, we have to take into consideration that we're moving in a bullish momentum, but we are in a bearish trend. So any bullish trades, any buys that we're looking to execute and take, we have to understand that we are, in essence, trading counter trend on the higher time frames. But the fact is the market is still bullish short term. So any buyers that we execute, we need to understand that we're looking to capitalize on them as quickly as possible and manage our risk as tight and as aggressive as we need to based on the lower time frames. Going into the 4 hour, we can still quite clearly see that we're making higher highs and higher lows, but recently we did break that structure to the downside, but we have, of course, most recently broke above it again. So quite a messy 4 hour time frame. If we were to delineate this particular section, then we can still see that we've got these equal highs around the 131, 132 handle. We've got some imbalance to the left hand side here, and we have correctively moved up to this structure. Bullish momentum, corrective breaks. So I still favour shorts, but I know, based on how this momentum is moving, that we could even tap into the upside liquidity around this area, because we still do have some imbalance and some areas of interest that we do want to tap into. Overall, I'd really like to see cable push to the upside to take out these highs, sweep the liquidity above that 135 handle, and then I'll be looking to take shorts heading into December and Q1 of 2021. So if we take a dive into the 1 hour time frame, we're now going to be introduced to the ASR, which is the Asian session range. If we zoom in just a little bit, the Asian session range for me, how I've set it up, is to take into consideration the Asian session, the London European trading session, as well as the US New York session. And the reason I do that is because when we trade London Open based on the Asian session range, I look to ride the momentum throughout the London session between 9 AM UK GMT and 11 AM UK GMT. I'll look to manage those positions with the view of not really taking any additional scale-ins, any additional trades, because we're heading into pre-US Open. And then once the US markets have opened, we then look to actively manage the position a little bit more aggressively. So if we just look at this particular area here, we've got the Asian session, we have the London session, which is also the European session, and the New York US session. So in terms of the Asian session as a whole, let's just completely get some clarification on that. The Asian session encompasses more than just one market. It takes into consideration Australia, New Zealand, Tokyo, and the Asia market as a whole. How we configure our Asian session range, the ASR, is I personally set it at midnight UK GMT until 5 AM UK GMT. The actual Asian session goes from 11 PM 2300 UK GMT all the way through to 8 AM UK GMT. So if we were to actually look at the ASR, the way mine is set up is 1900 hours based on Eastern time, and then it closes at 0100 Eastern time in the morning. And that just allows for me to take into consideration midnight to 5 a.m. based on the time frame I look to focus on the Asian session range. But again, just to clarify, the Asian session runs from 2300 hours GMT to 8 a.m. GMT. But we don't take into consideration all of that. We just look at the Asian range as a whole, and then we look to sweep that liquidity. So if anyone's having any trouble setting that up, feel free to reach out to either me, Brad, or any of the team members, and we can, of course, just run over that. I don't include all of the noise that is inside the ASR indicator box. You'll notice that there's several different levels, highs, lows, days ranges, pip ranges, etc. I just tend to keep to the bare minimum. We're looking at the actual session ranges and then the actual highlighted boxes that show the entire market movement. So time to colour up the charts, stick all the drawings back on, and really get into a few case studies of how we've traded the Asian session range into the London Open on cable. So just looking at the overall tone in terms of the markings and drawings that we've got analysed in front of us, we can see that we've got the equal lows and we've got these equal highs that have yet to be tapped into around the 132 handle, and the market is essentially moving in a bullish phase or a bullish trend, making higher highs and higher lows. However, we've recently created that highest high around the 131.71 level, and it looks like we're due to be tapping back into it. As the market correctively retraced, we can see that there's a really nice 4-hour AOI and a 1-hour AOI that is yet to be tapped into on this particular region here. Where we're going to start looking in terms of the Asian session is just this zone here. So just on the outset, every morning across my screens I'll have the 4-hour time frame, the 1-hour time frame, and the 5-minute time frame. The 4-hour and the 1-hour for me are to establish my bias for the day ahead, and then we move down into the 5-minute for the executions, either based on the extremities in terms of a risk entry or a confirmation entry, which is an additional confluence layer around order blocks, imbalance, and market structure. So the Asian session range, all we tend to do is we'll literally draw a horizontal ray line across the highest point of the market, and then quite simply again we will connect the lows and just horizontally stretch it out. Some do tend to stretch the opening candle or the opening price of 11 o'clock through to 11 a.m. all the way through, just because it tends to act as a midway radar based on the Asian session mid. So just looking here, the Asian session low have been tapped into. Really would have started to tap into that buy side and sell side liquidity. Depending on if you've got longs, you would have been stopped out, and if you're getting in short, you would have been started to be squeezed as the market moved back to the upside. Now, when the market sweeps, we're already knowing that based on this higher time frame bias, we're looking for longs. Now that we've swept to the downside, and then if we were to go into the 5-minute, we're then going to be looking to see how price reacts on the lower time frame, be it on the 1-minute or the 5-minute for executions. So there's 2 points of entry for the Asian session sweeps, be it longs or shorts. The first one we don't endorse, however it's one of the ones that many of us use at market execution. We just use a wider stop. So bear with me as I discuss this one, and again, I don't endorse this style of trading. I do endorse the latter, which we'll talk about very shortly. So as the market sweeps the Asian lows and taps into the liquidity below these equal lows, which depending on how we view the market could be seen as well as a non-textbook Wyckoff type A schematic accumulation, sending of course bullish momentum into the market, allowing us to accumulate a position and get long. As the market's created that momentum to the downside and swept that liquidity after the Asian low, the first execution method we could use and tap into is based on extremities, where we're actually looking to buy the market or buy cable as price starts to lose momentum and gradually decline in volume. So we've seen huge bearish Marubozu candles kick in, and then we've started to see the market correctively move here, and this is realistically where we'd be looking to buy the market. There's no real confirmation, there's no real order blocks, inequalities, imbalances, inefficiencies, or reasons other than the sweep of the Asian low. Now the strike rate varies around kind of 75-80%, but what we do need to factor in as well is we did have, as per the higher time frame, the 1 hour order block inside a 4 hour AOI and a larger 1 hour AOI at the bottom. So we have to bear that in mind. We could actually sweep all the way down into this area of interest to tap into that liquidity and that messy price action with the imbalance that we had experienced and seen on the 1 hour time frame. So when we're buying at the extremities, our stops are slightly wider. Now, I would never recommend, if I am even going to suggest this style of execution, I would never recommend having a stop tighter than 10 pips. My average on extremities is around 15 pips to 20 pips. So if I was to buy on the extremity, then I'd be looking to get in around here with my stop around 15 pips at the bare minimum. Our target for our longs, based on the momentum and during London session, is to initially target the highs of the Asian session. So we'll say that we targeted the highs originally without actually taking into consideration or factoring in that slight bullish momentum above that before the turn into the overlap of the New York session open. So if we were just to take the extremities on this particular trade with a 15 pip stop, the risk to reward ratio would have been 1 to 3 3/4. So 3.76% return on investment. However, by trading maximums, you have to have an increased stop loss. You are essentially catching a falling knife, and it does come with massive amounts of experience and discipline. The key word is discipline. Now, the reason I say that is because we're buying at the extremities, with our mental stops at 15 pips, it comes with some pros and cons. Because we have a mental stop in the market, we don't actually have a hard stop. Even though we're risking maximum 0.25% on a particular extreme trade, we can cut this trade a lot quicker if it doesn't work in our favour. However, if and when you don't have an actual hard stop in place, a couple of things can happen. If volatility kicks in, continued bearish momentum, liquidity starts to sweep even lower and tap into the order blocks below, we could easily lose more than what we've actually risked on the table. However, we know we have a mental stop in place, and that's where the discipline comes in. If the market does start to move against us, i.e. continue lower, then we need to have that mental strength and discipline to actually get out of that trade for a maximum of 0.25% risk and hit it at the market so that we don't continue smashing the bids to the downside and just rug pull what we've done. Now, it's still a good trade, but nevertheless, slightly riskier and for not that much reward. On 0.25%, it's banked us 3 3/4. So significant amount in terms of the actual ROI, just based on 0.25%, sorry. I know that I touched upon that earlier and I actually said the wrong risk to reward ratio. However, the area of interest and the style of entry that we prefer to take is a confirmation entry. So once the market has pushed to the downside, focusing on the 1 minute time frame for a clear break of structure, focusing on a clear break of structure to the upside, we had a nice break of structure here, here, and here. So when we had that break of structure here and here, we was initially looking for a pullback into this zone where we've got a really nice order block, where we have a really nice order block here to get involved. Now, we can reduce our risk to reward strike Now we can reduce our stop because we're looking at a confirmation entry. We know the market's looking like it's got bullish momentum. We've broke the structures to the upside on the 1 minute time frame, and our initial targets will originally be the highs of the market that has been printed, but that would only be to partially take trades off the table, with ultimately our target being the highs of the Asian session. So stops, realistically, it can be whatever your risk preference. You know, you could have had a 5 pip stop, 4 pip stop, and it would have kept you in quite nicely. It's not really much drawdown if we target the actual high. So 1 or 2 pips, maybe half a pip drawdown, with a risk to reward ratio in excess of 15%, just under 16%. So exactly the same trade, exactly the same sweep. The only difference is patience and discipline. So we haven't taken selling or buying at the extremities. We've waited for the market to break the structure to the upside after that sweep, tap back into that area of interest with that slight inefficiency and imbalance, getting in at the highs of the order block with our stop just below the wick, and then riding that trend. Now, what Brad and I do, and what the team do, is we don't actually take or manage our stop loss during this trade. We look to take partials during the London session. We then aggressively manage our trade and move our stop loss once New York has opened. But during the London session, we'll just look to take partials. Once the extreme was broke here, we took 25% off. Once the highs were broke around the mid-session of the open, we then took another 0.25%, so total of 0.5% taken off so far, and then we let the balance run, and then we start to move our stops. The reason we do that is because if the market does want to come back down and retest that level, we know we've only got 0.25% risk on the trade on the table, or 0.5% risk on the table, and then of course we're looking for that upside momentum. We don't want to choke the trade as it's moving, especially after the momentum has kicked in. Based on probability and strike, as I mentioned earlier, trading the Asian session in conjunction, in combination with order blocks, price imbalance and inefficiencies, market structure, tapping into equal lows, equal highs, and overlaying the Wyckoff methodology on the higher time frames as well, it makes our strike rate around 80% with a 10% deviant here or there. But one thing to note, guys, is these trades tend to set you up for the rest of the session. So as you can see, the London session has kicked in. As we start to overlap from the London session into the New York session, momentum has started to die down, and then the New York session takes it basically to the lows of the London Open, which you can see here, and then we continue moving back up gradually. So first case study, really, really nice trade, bullish move to the upside, banking just under 16% R. Moving on to our second case study within cable, shortly after in the next Asian session on the following day, we can see we've printed in the Asian low and the Asian high. So as the market started to come to a close and we're moving into the London Open, going down into the 1 minute time frame, we would have been looking for either a short play or a long play based on the bias we're looking at. Now, we were looking at shorts. So Asian range, really, really corrective. Really, really nice moves to the upside, tapping into the Asian highs and pretty much carving out a triple top scenario. So a lot of people would have been looking to take this long once we've broken to the upside. And of course, there would have been sell side liquidity there as well, looking to tap into the lows. So once market has swept, this particular scenario, two styles of trades. Of course, the extremity was the preferred trade if we are looking at the extremes. So if we would have sold the extremes, let's say we were selling this level here, stops would have been above this level. So realistically, you're looking at kind of like 10 pips or so. Targeting the lows of the Asian session. So risk to reward ratio, 3% return on investment for a 0.25% staked with a 10 pip stop loss at the bare minimum. Now, Had you have not taken the extremity on the basis that you was looking for a confirmation entry, you wouldn't have actually got into a trade. Now, if we zoom out just very quickly, what are we noticing? So we've seen the sweep of the Asian highs, tapping into a lot of the liquidity and tapping into some stops from shorts, sweeping the highs, and then moving down to the downside, which if we actually look up until around 8:30 in the morning, markets were moving to the downside, and we had tapped into the area of interest that I highlighted earlier on in the commentary, and then moved back up to the highs towards the New York Open, which really, really nice sweep, really, really nice play. And I know a lot of people would have actually then looked to take this trade here to the upside, tapping into, of course, the bullish order block that we've obviously factored into this session, moving back into the New York session, and then kind of correcting all the way through. So really, really nice short trade. If you had actually held to the lows, just on that, you could have got a 4% move. If you had decided to go slightly risky, now I don't endorse it, I mentioned this earlier, but let's say because we are moving into the London session, you took a 5-pip stop, and then you would have banked around just over 8% on that particular trade. And moving on to the third and final pair, which again, cable, nice long trade. Asian session, got the range pinpointed, Asian high, Asian low. So we wouldn't have necessarily had a sweep of the lows, depending on where you've actually drawn. Let's just quickly move into the 1 minute time frame. I didn't take this trade. This is just a pure case study. Okay, actually we can refine it. So there's the actual low of the Asian session. We've breached the low, we've swept the low, and we've tapped into the liquidity on the downside. Just narrowly missing this area of liquidity, which 129.40, depending on spreads, may have actually got you tapped in. Unlikely though. So if you were buying the extremities of this, your stop would have been comfortably below the order block, setting momentum, the range into the Asian session and to the London Open, riding the trend all the way up. So you would have hit the Asian highs, 0.25% taken off of the table, and rode it throughout the London sessions all the way through to the New York session open. With a maximum of around 17% on offer. Let's say once the market had kind of started to correctively move and open into the New York Open and head over into Asia, you'd have really been tightening up on your stops and risk. So realistically, you would have probably banked and been out for around 13% on that trade. A really, really nice trade overall. Textbook sweep. Would have taken into consideration the equal lows and the extremities here. Of course, we had the extreme lows tapped into and the equal lows on the Asian session. But how we always monitor it, just so that we can summarize, is on the 1 hour time frame, we look to map out the Asian high set of the session and the low of the Asian session, taking into consideration the 1 hour on the 4 hour time frame and where the markets are in the overall structure. We've got some really nice area of interest below the Asian low, so we are targeting moves to the upside based on the order blocks and areas of interest. Once the market is swept into the lows, we're either looking to buy or sell at the extremities or looking for a confirmation entry. If we're taking an extremity trade, a risk entry, our stop is going to be above 10 pips. If you're a little bit more risk averse, if you're a bit more patient, you're going to be waiting for the confirmation entries. Now, on 2 of the case studies I've shown you, we've only had 1 confirmation entry. Now, I don't endorse the risk entry or selling or buying at the extremities. However, based on the strike rate, keeping our risk to the bare minimum and factoring in all of the additional confluences and this advanced entry technique, you're pretty much setting yourself up for extremely high probability trades when utilizing the Asian session range, price imbalance, areas of interest, market structure. So what I do encourage is this weekend, if you can, go over cable, sterling yen, euro GBP, dollar Swiss for the last 2-3 weeks at least, and just look at how the Asian session ranges play out and where the momentum kicks in. So what we tend to see and what we tend to find based on all of our trading and all of our back testing and all of our ASR is once we've seen a sweep of the Asian highs or the Asian lows, that tends to set the rhetoric and the tone heading into the London session. So if we saw a sweep of the lows, then we're looking for longs, which tends to take us all the way long through until the New York US Open. And we then regularly see markets reverse, and actually we see New York Open and look for shorts, taking us back down to the London highs or the London session open before we then continue moving to the upside. So once you understand how to trade the Asian session, factoring in the London zones and the New York zones, it really sets you up and gives you the best opportunity at really giving yourself the additional confluence required when tapping into the other pieces of the Phantom methodology. I really hope you've enjoyed this video, guys. I know that I can be a bit wishy-washy and delve off and dive off into different areas and realms quite easily, just because I can talk about the markets all day. But feel free to tap into my DMs and ask me any questions. Over the last 2 weeks, look at Euro GBP, Sterling Yen, Cable and Dollar Swiss, and just apply the Asian session range to your trading and just see how much you could have refined your entries and what that would have done for your absolute returns. But thank you very much, and I look forward to releasing the weekly commentary for you on Sunday. So have a nice weekend. Spend some time with your family, friends and loved ones, and get in front of the charts to increase your probabilities. Thank you very much.